Hi, this is part of lessor accounting. We're going to talk about once you've classified it as sales type lease, how do you figure out the amount to capitalize? Well, the amount to capitalize is going to be contained in the lease receivable. So you're going to have a lease receivable entry that's going to be the present value of something. So what we're talking about is what are we going to present value? So you have with a lease problem, you're creating your own present value problem. So we have a timeline that looks very not straight. Let me use this little thing that you have here, see if I can make it straighter. Oh, it's straightened out for me. That's beautiful. I'm getting a little misty because it's so correct. All right, I'm going to take that off so I can do 1, 2, 3, 4. So let's say you have a lease payment, a lease payment, a lease payment, a lease payment. Most leases are annuity due. 1, 2, 3, 4 payments, and here is lease end. So you have to create your own present value problem. So you're going to have to figure out the lease payment. And then here sometimes we're going to have other stuff, the very technical GAAP term, other stuff. And we'll talk about it because essentially, as in many things in your accounting, what payments you include in a present value are dictated by GAAP because we're calculating, or in accounting we call it measuring, the lease receivable capitalized. So let's see what we have over here. The lease receivable will equal to fair value when there are these things, when there are, they exclude executory cost. Okay, so executory cost. What are executory costs? Let me get this eraser out here, make some room. Executory costs are things like payments for maintenance, taxes, insurance. So they're generally associated with periodic expenses when they're outside of the lease payment. Okay, so executory cost, maintenance, taxes, insurance. There might be others, but those are the big three. Maintenance, stuff that when you own it is a periodic expense. But sometimes you might get into a car lease and they say it's $350, including $50 a month for insurance, right? So the executory cost could be included in the lease payment. So if it's not, if fair value is not given, and just assume, really, you should really just assume, do the present value calculation. The lease receivable equals the present value of lease payments plus the present value of any unguaranteed residual value. And it's all going to be discounted at the lessor's implicit rate. So the rate is going to, let's start with the rate because that's the simplest. The lessor has a rate that they use to determine what a reasonable lease payment is, what a profitable lease payment is. And that's the rate that'll be used in present valuing all the cash flows that GAAP includes in the lease receivable calculation. Okay, so basically you have to analyze the lease and determine the cash flows that are on the timeline and then discount those at the lessor's implicit rate. And so far, the simplest thing I've told you is use the lessor's implicit rate because in the problem, it'll tell you their implicit rate is whatever it is, 8%, 10%. Okay, now I'm going to talk about when the item is returned and when the item is transferred to the lessee at the end. And what gets confusing is how we deal with the residual value. So you take the present value of the lease payment. So basically every calculation is going to have a present value of some annuity of payments, which we're going to talk a little bit more about. And then in addition, there may be a lump sum at the end to deal with. So this first equation I have the present value of, and you can't see me, but I'm air finger quoting lease payments. We have to define exactly what lease payments means for GAAP purposes. And then the present value of any unguaranteed residual value. So an unguaranteed residual value means that the lessee didn't make any promise to the lessor to make a payment if the residual value falls below some level. Okay, so when they guarantee the residual value, they say, hey, if it's the car's not worth $5,000 at the end, it's only worth $3,000 up, the lessee will pay a $2,000 difference. If it's over $5,000, the lessee doesn't get anything. They're just making a guarantee. So to break it down a little further, now I call rent payments. Rent payments are just the stuff that's included in the cash payment that the lessee will make every month or year or whatever. But the lease payments include other stuff. For example, the guaranteed residual value as a lump sum at the end, if there is a guarantee. Renewal penalties as a lump sum at or near the end, if there is any. Though that's part of the other stuff. Rent payments plus now the executory costs are usually an annuity. So if the lease payment includes the rent payment, which is the use for rent, plus the executory cost, that would be in there. But it also includes, finally over here, any residual value guaranteed or not. Okay? So whenever the item is returned, you're going to take the present value of the residual value because the lessor is going to get it back. In one case, they have a guarantee to get that amount back. In another case, they're just estimating or guessing, hey, I'm going to get this car back in 5 years. It's going to be worth $5,000. But they're still counting on that. Okay, so whenever the item's returned, include the residual value guaranteed or not. When the item's transferred from the lessor perspective, they don't get it, so they have zero residual value. So the problem might say it has a $5,000 residual value, but in fact, since the lessee gets it, because the title is transferred at the end to the lessee, the lessor's effective residual value whenever the item is transferred to the lessee at lease end is zero. So this can be confusing, these two cases here, the difference between. So that's why I laid them out, is just to remind you that, hey, when the lessor doesn't get the item back at the end, their residual value is zero. Okay, and then, hey, look at me. I tell you again, here, when the item is transferred to lessee, lessor residual value equals zero. So there are some leases that transfer ownership where essentially it's lease to own. You're just entering a lease to end up buying it. Okay, so the lease payments, this is a GAAP definition. Definition. There's annuity type payments, which are the fixed lease payment, which could include executory costs. Okay. Variable payments based on a known index or rate. So if you pay an amount like $100,000 a year, and then you know that it's going to go up 3% a year fixed, then you would include that 3% a year increase in the annuity type payments that you're going to present value. Okay. Now, if it's based on an index like the S&P 500, which is it's variable but unknown or random, then you don't include those in the capitalization. You would just expense those as incurred. All right. So variable payments that are knowable are included. All right. And finally, executory costs that aren't included in the fixed lease payment, but that are themselves fixed. So let's say you pay $300, and in addition, you pay an extra $50 every month for maintenance, taxes, and insurance. You would include that. If you're required to pay executory costs, but it's your job just they'll service it and then they send you the bill, whatever it is, that would not be part of the lease payment, because that would just be, oh, you did the maintenance, we did the maintenance, we sent you the bill, you paid it, then it's maintenance expense. Okay, we're identifying what GAAP says has to be in the present value problem that you're creating to calculate the amount of lease receivable. And then finally, in addition, there's these lump sum type payments that are at or near the end, and you have to be we have to be clear that this is if they're there. So it's not, they're not always there. So you have to analyze the lease and say, is it there? Do I need to put it on that timeline? So if there's a guaranteed residual value, put that at a lump sum at the end. A bargain purchase option. So you lease a Cadillac Escalade brand new for 5 years. At the end, they say you could buy it for $500. That's going to be a bargain because you couldn't buy the wheel on that car for $500. So you would put $500 at the end as a lump sum. A termination option. So an option to terminate the lease. So you can terminate the lease early, but you got to pay, $10,000. Okay. You're going to include it only if you're reasonably certain to do that. Okay. So that's what's included. And then finally, as I said before, which interest rate are you going to use in calculating this present value? The lessor always uses the implicit rate. So there's really no choice. You just have to find that rate. All right. So that's just a general overview of the present value problem that you create to find out how to capitalize the lease receivable. We'll step more into actual numbers in another video.